Okay, so today we're going to talk about stock valuation, right? And uh, we had a discussion of bond valuation before, and valuation in financial terms of any assets. It's really just based um, on the present value of all the future benefits that uh, we expect to obtain from. So even if you're buying an office building, well, you're going to use it in the future, um, and uh, perhaps get some rent from other people who are renting out space in that building. But those are cash flows that you're going to generate in the future. And so, how much should you pay for the building? Well, it's going to be based on well, those cash flow expectations and their present values, right? And um, it's kind of what we did for bonds. We calculate the present value of all the interest payment and then the par value, and it's similar to what we're going to do for stocks. The only problem is stocks do not mature, right? The stock has, at the outset, it doesn't have a finite life. It can last forever. As long as the company is around, your stock will be around. Only um, so only times we have this issue with stocks not performing well would be if the company gets in trouble and goes bankrupt. And sometimes people will buy out companies, and a public company then becomes a private company. In which case, you will basically get cash for the shares that you own. Anyways, so um, the trouble with stocks is that the future cash flows are not certain, right? As with stock, you're buying a piece of ownership in the company, and basically the profits from that the company generates will be used to pay out dividends, etc. And that's what a stockholder gets. And of course, you hope that the value of the stock also grows because you're holding a share of the company, and if the value of the company grows, then the value of the share that you're holding will also grow. And so you're hoping that um, eventually you'll be able to sell that stock for a greater price, right? So that would be the capital gains component. Um, However, dividends are residual profits, right? So their profits for a company can actually um, deviate a lot from one year to another. They're not promised payments like interest payments on a bond. Those coupon payments are fixed with stock. That's not the case. So it becomes a little bit difficult. With some exceptions, we can expect a stock for a mature company to actually pay fixed dividend payments year after year, right? And um, and then there's a certain kind of stock it's called preferred stock, right, where dividends are fixed, and the company is not allowed to skip those dividend payments. If they do skip dividend payments on preferred stock, they have to make it up the following year. So in those instances, um, we can value share of stock, right? Like for instance, here's one. Old Geezer Incorporated is a mature company which has exhausted its growth prospects. And as such, its earnings and dividends are expected to remain constant at $3 per share. Shares of firms with similar growth and risk characteristics as Old Geezer require a return of 11%. How much should you be willing to pay for one share of Old Geezer stock, right? So what has happened here is that we've come to a point where the company is not expected to grow anymore, but it's expected to stay um, at the same place, and being profitable, but the profits that don't grow, company doesn't grow. So the dividends are going to be $3 per share year after year. And then what that means is that we actually have a perpetuity. Remember, there's perpetual annuity, perpetuity of $3 per share. And we had also learned that it's really easy to find the present value of a perpetuity, right? This is a zero growth company. Dividends expected to remain constant until the foreseeable future. And basically, this is a code words for saying as long, until forever. So we can use the perpetuity model. Fair market value of stock should simply be present value of $3 perpetuity evaluated at the rate of return. If you remember, present value of perpetuity was simply payment divided by the interest rate, right? So the price of the stock today, P0, is that dividend, the constant dividend divided by the required return in the stock. So this becomes the constant dividend model, right? If the dividends are constant, then the price simply, and that dividend divided by the required return. And when we crunch that out, $3 divided by 0.11 for 11%, that gives us $27.27, right? So that's the price of this company's stock. What would be the price of this company's stock next year? The same, right? Because again, a year later, if you're looking into the future, you have a $3 payment in perpetuity, and its present value is $3 divided by the required return of 0.11. So the only time the price of this stock will change is when the required return changes, right? And that can change over time due to changing interest rates, changing risk assessment of this company, etc. Okay, so the other kind of stock that does have fixed dividend payments is called preferred stock, right? And so here's one. Wind and Gone Corporation has exhausted its growth prospects. Mr. I Know Best decides it would be best to invest only in the company's preferred stock, which pays a dividend of $2 per quarter, right? If Wind and Gone preferred stock currently selling for $50, what is the simple annual return that Mr. I Know Best can expect? What's the effective annual expected return? Now, the reality is that companies pay dividends in many ways. Most of the dividend-paying companies in the U.S. pay dividends on a quarterly basis, some on semi-annual basis. But because the time horizon for stock is so long that we can safely ignore this fact and simply use annual dividends, right? And that's what we'll be doing for the most part, except in this question because we are given the quarterly dividend. So if the preferred stock is currently selling for $50, what's the simple annual return? And what's the effective annual return, right? So what's the nominal rate, which will be the APR, and then what's the effective rate? Well, remember that this has fixed dividend payments. It's preferred stock, and but by design it has fixed dividend payments. And once again, we can apply the perpetuity model, right? And what was the perpetuity model? It said the price equals dividend over the rate, R. And so R equals dividend over price, okay? And that we can use that here, and R is $2 in dividend divided by $50. Price of the stock, which is 4%, but this is 4% per quarter. So the nominal rate is 4 times 4, which is 16%. That's 16% APR. And the effective rate is then 1.04 raised to the power 4 minus 1, or 16.99%. And I'll take you to the calculator for this one. 1.04 y to the power x 4 equals minus 1 gives us that 0.1699. Also remember that you have a I-convert function in your calculator, so you could just go to second and 2, which is I-convert, and then for nominal rate you can input the 16%, right? 16%, which was the nominal rate. Input that 16, enter, and then go to C by Y. That's quarter. It is quarterly, so C by Y should be 4, which is what is already in my calculator. Then go back up 1, and when you see EFF, you hit compute, and you'll get the answer, which is 16.99%. Okay, so on to the next question then. Here we're going to be looking at a slightly different model called the constant growth model. And here, if dividends can be expected to grow at a constant rate, forever, then, and that is of course modest amount of constant growth rate, it can't be very high growth rate forever, because then the company is actually going to become very large, take over the industry if it's growing really fast, and keeps on doing that, take over the economy and then take over the universe, right? So we can't expect a company to grow at a very fast rate forever, but we can expect them to grow at a fast rate for a smaller period of time and then grow at a more modest rate, like here. So Howdy Doody is a greeting card manufacturer. It's planning to enter a niche market, but it will introduce a new celebratory products with wishes such as Happy New Month and Happy New Week. Breaking new ground, the firm is expected to grow at a rate of 7% until the foreseeable future. The company has just paid a dividend of $2, and the required return on its stock is 10%. What is the most you're willing to pay for Howdy Doody stock? Right. So basically, we are looking at a company whose dividend payments are expected to grow at a constant rate until the foreseeable future, which is again forever. Since we have constant rate of growth in perpetuity, the constant growth model applies here. And what's the constant growth model? It says current price, P0, equals next year's dividend, D1, divided by R minus G. And R is the required return, and then G is our growth rate, right? And an essential condition for this to work is that G must be less than R, right? Of course, if it's not, you can already start to see that if G is greater than R, then this equation will give us a negative value, right? But if G is greater than R, then we're talking about a very high growth company, and its stock price can't be negative. It has to be really, really high, right? So this is basically, this formula only works when G is less than R, right? So G is less than R is a necessary condition for this model to apply. Also, we need to know that G is the growth rate applicable to dividends beyond D1, right? So you're buying the stock today, over the next year you get a dividend, and then from that point on, the year after, your dividend should be growing at this rate of G. But what about between now, the most recent dividend and the next year's dividend? Well, that does not necessarily has to grow at G. Okay, that doesn't have to be, because the formula says you take next year's dividend, because you buy stock today, you're only looking at the future benefits. So dividends over next year and beyond, right? But if the growth in dividend between now and next year may or may not be the same as G. However, if the growth rate during the first year is also G, then we can say that P0 equals, instead of D1, we'll say that most recent dividend D0 times 1 plus the growth rate will give us D1 in the numerator, right? D0 times 1 plus G divided by R minus G. And this is just a special case when the growth rate's already at G, and um, you know, so next year's dividend will be that much higher. All right, so for how to do this talk, we were given the values of G as 0.07, value of R, which is 0.1, and the most recent year's dividend, $2. So $2 times 1 plus 1.07, 1 plus 0.07, which is the growth rate, right? So 2 times 1.07, that would be, what, $2.14? Then divided by 0.1 minus 0.07, so you're dividing it by 0.03, and you get $71.33. And that is the current price of this stock. Right? All right, so a firm recently announced earnings of $4 per share with a required return of 10% in the firm's stock. The discounted value of a $4 perpetuity is $40. Yet the price of firm shares have been hovering around 55. Mr. What the Heck wonders what might be causing this to occur. Can you help him out? So, and this question actually ties back to the previous two questions in a sense, because, when we were looking at this constant dividend model, we saw that given a $4 perpetuity, a $4 dividend year after year after year, when we divided by 0.1, the required return, we would get $40, right? But the price is 55, right? And why is it so? Well, in the second, or the previous problem, we encountered the answer. And the answer would have to basically revolve around growth, right? So if the firm has no growth prospects, then it'll distribute all of its earnings and dividends. And then its $4 earnings per share is also its dividends per share in perpetuity, right? So this, if we apply the constant dividend model, then the price would be $40, right? But this firm's stock price is substantially higher than $40. And that means that the company has positive prospects for growth, in which case a constant growth model may be applicable. However, facing growth prospects, the company will not distribute all of its earnings as dividends, right? So the dividend will not be $4, because the company will maybe say just give out $3 in dividend and keep $1 to fund its future growth, right? To have capital for growth if there are growth opportunities available. So if the portion of earnings retained by a firm, that is its retention ratios denoted as B, right? So B would be the amount of earnings per share that the company is keeping back for future investment. Then we can use the constant growth model as shown below. So we take the company's earnings per share and multiply it with 1 minus B, then that becomes dividend per share, right? So because you're not giving all of it out, but keeping B a proportion back. So that would mean that the current earnings is not dividend, but a little bit less than that is dividend. Of course, we are interested in next year's dividend, D1 in the constant growth model. So we will make that grow for 1 year by multiplying it with 1 plus G. And then we're going to divide the result with R minus G. And of course, given what we know that $4 is the current earnings per share, and 0.1 is the R. Even if we plug those in, we actually have two unknowns, B and G, so we won't get the values of those. But that's what yields us $55. That's what results in a $50 or $55 price, right? Um, so we have two unknowns and one equation. We have insufficient information to get the values of G and B, but the concept is what we were after, right? However, we do know that the extra value comes from this company's opportunities of growth. In fact, this has a name too. It's called present value of growth opportunity, or the company's PVGO, which is the $55 price minus the $40 price it would have had if without any growth opportunities. And that's $15 difference is the present value of growth opportunity for this company. Okay, now let's get to somewhat more complicated types of stock valuation problems, because oftentimes you really just have a short holding period in mind, 2, 3, 4 years, 5 years for a stock, and then you want to sell it. And so holding Fargo Well stock leaves you insecure about a long-term investment horizon. Instead, you intend to hold the shares you purchased for $48 each for 3 years and then sell them. You expect to be able to sell each share for $51 after 3 years and receive dividend payments of $0, $4, $4.50 during your 3-year holding period. And estimates like these, over the next 3-5 years actually are provided by many stock analysts. So there's a thing called value line report, and you could look for that. And the value line report actually, of course, you have to purchase it, but for the 30 largest companies that make up the Dow Jones Industrial Average, the Dow, for 30 companies that make up the Dow, the value line reports, you can view them for free, right, at valueline.com. And if you go to one, go pull up one of those, you'll see that the future dividends over the next 3-5 years and a selling price for the stock is actually provided in that report. So, and of course, that's only one of the analysts out there. There's lots of other analysts out there that can provide you with estimates like these. So anyways, so you expect to be able to sell each share for $51 after 3 years and receive dividend payments of $0, $4, and $4.50 during the 3 years you're holding that stock. So what is the expected return on this stock? And the next question is, if the required return on Fargo Well stock is 10%, is it a good buy, right? So let's look at the timeline of this stock, right? It says you're going to pay $48 and you will get nothing the first year, $4, second year, $4.50 in dividends the third year, and you sell it and you get the price of $51, right? So $48 is the present value of future cash receipts, which are the subsequent dividend payments and the selling price of the stock, right? In other words, first cash flow is $0. We can ignore that. But what is $48? It's the present value of all of this benefits we expect to get from buying the stock today. And so, of course, in any present value calculation, there is a rate, right, an interest rate, and that would be the required return on the stock. So what is not given to us is the required return on the stock, okay? We got the $48 that we pay. We're going to get $4 2 years later, so its present value will be 1 plus r raised to the power 2. And then we get 450 plus 51, or 5550. And that is 2 years from now. And I'm sorry, that's 3 years from now. So divide that with 1 plus r raised to the power 3 to get the present value. And to calculate this r, of course, is going to be pretty difficult, right? if you want to do it by hand. It's kind of like calculating the yield on a bond, and you're really going to have to use guesses and close in on the answer over like several iterations. But we use a financial calculator, we can easily get the answer. So we're going to go and go to, let me get out of here. We're in that mode. It's the second compute to exit or get out of there. And we need to go into cash flow mode, CF0. We're going to put that, we're buying the stock for 48. So negative 48 is CF0. Then CO1 is 0. So we don't need to punch 0. You can, but it's already on the screen. All we have to do is push enter, and now we can go further. So then this next one is F01. That's the frequency. In this mode, in this cash flow mode, the frequency can be used to say that the cash flow that I entered earlier repeats so many times, right? So CF0 is 0, and if, sorry, C01 is 0, right? C01 is 0 because CF0 was minus 48. C01, the next cash flow, is 0. And if this 0, if we had 5 years of $0 cash flows, then rather than putting, 0 for CO1, CO2, CO3, CO4, CO5, we can simply say the frequency is 5. Okay, but the frequency this time of 0 is only 1. Then C02 is $4. That's the dividend that we get 2 years from now. Enter that. Then frequency of that is 1. Then C03. Now C03 is the $51 that we get from selling the stock, plus the $4.50 that we get in dividends, and that's 55.5. Enter that. Right? So we got all the cash flows in. Make sure minus 48, then 0, then 4, then 55.50. And once we have all the cash flows in, we need to compute the internal rate of return. We'll learn more about IRRs later, but that's the button we need to use. In the cash flow mode, the relevant buttons are in this second row of keys. So IRR, when we see IRR on screen, hit compute, and the answer is 7.6%, right? Now, 7.6% is the return that we get from the stock, but we were told that the required return on the stock is actually 10%. So if you remember from the capital asset pricing model, we have a stock whose return falls below what is required, which would be what would be on the security market line. So this is an overpriced stock. It's not a good buy, right? Of course, another way of getting that answer was to simply calculate the price of the stock, because we know that the cash flows from the stock, just zero out the initial cash flow and leave the others in. This is what we're going to get, $55.50 and $4, right? And if we calculate its present value of these, we use the NPV key, and for I push 10. 10% is the required return. Enter that, and then arrow down. When you see NPV, hit compute, and what we find is the stock price should be $45, right? But it's selling for 48. So once again, we can conclude that it is an overpriced stock, right? It's not a good buy, so say goodbye to this stock. Okay, so now let's look at something slightly more complicated because now we have to apply um, our knowledge from the previous couple of problems and put them together here, right? So Coca-Pepsi Incorporated has developed a new hybrid cola product. Early market tests have determined that this new cola will gain wide market acceptance during the first few years. Hence, the firm's earnings are expected to grow at 15% per year for the next 4 years. Growth will stabilize to a normal rate of 6% per year after 4 years. Recently, Coca-Pepsi had paid an annual dividend of $3 per share. The required return on Coca-Pepsi stock is 12%. What is the horizon value of each share of the stock? What is its intrinsic value today? Oh, so I'm sorry, I got distracted just a second. Um, so sorry for the pause, but we are looking at a company whose earnings are going to grow at a pretty fast rate, 15% per year for the next 4 years. And then it goes, stabilizes to a normal rate of 6%, right? Um, so given that we have the most recent dividend payment, we can make it grow at 15% per year for the next 4 years, and we will get the dividends over the next 4 years. And after that, only after that, does the dividend start to grow at 6% rate, right? So what we can do there is to apply the constant growth model, and then we can actually treat it just like the last problem we did. So let's look at it in the timeline, right? We have basically we got stock whose dividends we can compute. So you can get D1 is $3 times 1.15 with 15% growth. D2 is that same value but grown again by 15%, another 15% growth. D3 is 15% growth over 3 years. D4 it's 15% growth over 4 years, right? So we get, and then D5 is going to be D4, which is 1.15 times raised to the power 4 times 3 multiplied with 1.06, because now growth rate now it has become 6%, right? And so beyond that, of course, growth rate will remain at 6%. So what we can do is, knowing that growth rate and dividends will be 6% per year beyond the 4th year, we can apply the constant growth model to assess the stock's value at year 4, right? So we can get P4 because D5 and we have a value for D5 and growth rate is going to be 6%. And this P4 is called the horizon value, right? And that's the horizon value that you will see in your book or in your homework assignment. And that would be P4 in this case. That's from the point beyond which dividends are growing at 6%, right? And it's where we are going to be able to use this constant growth model. So let's calculate P4 using the constant growth model. Remember, the constant growth model said today's price P0 is D1 over R minus G. Well, likewise, P4 is D5 over R minus G, right? And so D5 is this value, 3 times 1.15 raised to the power 4 times 1.06 divided by 0.12 minus 0.06. And so you crunch that. So we're looking at 1.15, 1.15 y to the power x 4 equals times 1.06 equals. So, and then all that multiplied with 3, that's 556. But 556 would be dividend after 5 years. Then we divide that with R minus G, and we are given the values of R as 12%, and growth rate, of course, is 6%, which we have already used to get D5. So 0.12 minus 0.06 will be 0.06, right? So divide this value with 0.06, and we get the answer, which is 92.697 or $92.70 approximately. But this is an intermediate calculation, right? We only know the price after 4 years, but we have to determine the price after price as of now. So I'm going to store this number, store 1. Well, then, now if we look back at this problem again, and we modify the timeline, this now starts to look just like the last problem, right? Because we know the price after 4 years, so we can view this as, well, how much are we going to pay for the stock to get these dividend payments over the next 4 years, and then we can sell the stock for $92.70, right? And of course, that the calculation, because we have 12% as the required return, these are just present value calculations. So the present value of the first dividend payment, 3 times 1.15, that'll be 345 divided by 1 plus 0.12, 1 plus R. So, and then that's D1's present value. This is D2's present value. This is D3's present value. And this is the present value of D4 and P4, right? 7174. Obviously, we could do this using our calculator, the cash flow mode. So in the cash flow mode, I'm going to say for second C/C to clear it of anything from previous calculation. And then we got to leave CF0 as 0, right? So CF0 is 0, then go to CO1, and here we put 1.15 times 3 equals 345, enter. Right. Go past FO1 to CO2. For CO2, it's 1.15 squared times 3. That is the second dividend payment. Enter that. Then go past FO2 to CO3, and for CO3 we're gonna do 1.15 y to the power x 3 equals times 3. That's the third year 3 dividend payment, and so that's CO3. Enter that, and go past FO3 to CO4. Here we have to find the D4, which is 1.15 by the power x 4 equals times 3 equals, now that's the dividend, right? But also now we're going to sell the stock after 4 years, and so we will get the price. So add to it the price we had calculated before, that was the price of the stock in 4 years, equals, so you just added the 4 dividend and the stock price after 4 years, and that becomes CO4. Enter that, right? And now all the cash flows are entered, and we need to calculate its present value at 12%. So it's NPV for I, push 10, enter, arrow down. When you see NPV on the screen, hit compute, and you'll get the answer. The answer is $71.74, right? That is the answer that you'll get. That you'll get if you use this, the formulas for present values, and that's the answer we get with our calculator functions. That makes it so much simpler for us to crunch these numbers. Anyways, I'm going to tell you that we could do this problem with one less step. Actually, we could get the answer with one less step, right? The only reason we talked about horizon value, which would be P4, because dividends grow at 6% beyond D4, right? And so horizon value is the value of the stock after this high rate of growth is over. And so the book talks about horizon value. You get homeworks that ask about horizon value. There are questions about horizon value that you might see on a test, and that's why we went through that process last time. But if you remember, when I was introducing you to the constant growth model, I said, the constant growth model says P0 equals D1 over R minus G. And so the G has to apply beyond D1, right? And not necessarily between now and D1, between D0 and D1. It doesn't have to be the case. Once we get that realization, we can actually shorten our problem here by not having to calculate D5 and calculate P4, right? The only reason I brought up P4 is because it has a name. It's known as horizon value, and your book introduces you to, and the way we did the problem in the last slide, that's how the book tells you to solve this problem. But you don't actually have to do that. You can save a step, right, by realizing that G2 that applies is after D4 itself. So we can take the value of D4 and calculate P3. P3 is D4 over R minus G, right? We know that the dividend growth rate between 3 and 4 is not 6%, but it doesn't matter because P3 is going to be based on that next dividend and all the dividends beyond that. So the only growth rate that matters is here. Once we know the value of D4, right? So once we know the value of D4, we can calculate P3. And so P3 is simply $3 times 1.15 raised to the power of 4 over 0.06. And if you do that calculation, you'll get 87.45, right? That's the price. And now we can basically say we'll keep the stock for 3 years, we'll get these dividend payments, and you can sell it for 87.45. Given that, what's the price? of the stock. Of course, using the formulas, we'll only have to go as far as 3 years, right? The first year's dividend, second year's dividend, third year's dividend, plus the price after 3 years. And when we calculate the respective present values and add them up, we'll get the answer. And it's going to be the same as before, 71.74. Let's check that out with the calculator. So if we go back to cash flow mode, we had C1, C2, C3, which was the third dividend payment, right? And then C4 was the fourth dividend, and P4. Well, let's zero this out. We don't need this. Let's zero it out, right? So now, let's see, C1 will be the same as before, the first dividend payment. C2 will be the same as before, the second dividend payment. C3, now C3 is going to be different. It's going to be this third dividend payment for plus the price after 3 years, which we had calculated earlier, right, to be 87.45, right? So add to this 456, 87.45 equals, and we get 92.01. That becomes CO3. Enter that, and then go to NPV. I will stay at 12%. We can leave it there, arrow down to NPV, and hit compute again. And you see that we get the same answer, right? There's a little bit of difference beyond the second decimal place, and that's only because I input the rounded value of P3. But if you round it up, you'll get the same answer, $71.74, right? Okay, let's moving on. We go to the next question. It says the expected return on the market portfolio over the next year is 15%. 1 year US Treasury bills pay 5%. Alpha Company shares are selling for $48. The company's earnings and dividends are expected to grow at a constant rate of 6% per year until the foreseeable future. So alpha's beta is 2.1. Right? We get the beta of this alpha company. We have risk-free rate, treasury bill rate, right? Market portfolio return, market return 15%. Well, all of this means that we can calculate, using the capital asset pricing model, we can calculate its required return, right? And what is the required return using the CAPM model? Well, risk-free rate plus the market risk premium, which is the market return minus the risk-free rate, right, times 2.1, which is the beta of the company. Once you do that, you see that the total return from alpha stock should be 26%, right? And in the constant growth scenario, the growth in dividends matches the growth in capital gains, right? And so alpha's capital gains yield will be 6% given its growth rate in dividends. So let's look at the question again, right? We see that the growth rate is given at 6%. So we know that, so we know that capital gains is 6%. That's the growth rate, right? As a matter of fact, if you think about the constant growth model, it says P0 equals D1 by R minus G. And so we can say it the same way, P1 equals D2 by R minus G. And what's the difference between the two? Only the numerator. Instead of D1, we're using D2. And the denominator, R minus G, remains the same. And the numerator, D2 is 6% higher than D1. And so P1 will be 6% higher than P0, right? For that reason. And that's the capital gains. Capital gains rate is the growth rate in the constant growth model. So there's two components to the return stock, capital gains and dividend yield. So if capital gains is 6% and the total return is 26%, then dividend yield is simply the difference between the two. It's 26 minus 6, or 20%, right? So that's an important thing to remember in the constant growth model, that we have capital gains rate given to us. That's the growth rate in dividends. All right, now we're going to look at something called market multiple models, but these are pretty easy to apply, right? So Oopsie Daisy Incorporated reports the following expectations for next year. So next year's earnings per share is $1, right? Cash flow next year is $1.20 per share. Sales next year is $3.15 per share, right? So upon conducting some research of comparable firms or peers, you determine that the average PE ratio is 20, price to cash flow ratio is 17, and the price to sales ratio is 6, right? PE ratio stands for price to earnings ratio. What's your best estimate of Oopsie Daisy's stock price? Well, the use of market multiples assumes that peer average or market multiples reflect the true multiples for business. Then multiplying a market multiple with the next year's projected value of the metric will yield stock's price, right? So once again, the PE ratio, which we believe to be true for this group of peers, should apply to this company, times E1, next year's expected earnings, will give us the price of the stock today. So 20 was the PE ratio and 1 is the price. Likewise, using the price to cash flow ratio, multiplied with next year's cash flow per share. So that was 17 times 1.2, that gives us $20.40. Price to sales ratio times sales per share next year. That is $6 per share times, $6 price to sales ratio times 315, which is sales per share next year, gives us $18.90. So we used 3 different metrics. We got 3 different answers. And of course, we can have errors in any one of these. So the best thing to do to get the best estimate is we average these. And basically, best estimate of Oopsie Daisy stock will be an average of the 3 values. By using an average, we hope to dilute any errors in individual estimates. So the best estimate is then the 20 plus 20.4 plus 18.9 divided by 3, and we get $19.77. Okay, now we're going to look at something called the free cash flow approach, right? So the 594U Corporation reported free cash flows of $300 million during its most recent fiscal year. Analysts expect the firm and hence its cash flows to grow at 5% per year until the foreseeable future. The firm's weighted average cost of capital is 10% and has a current outstanding debt worth $2.3 billion. The firm has never issued preferred stock. The firm has 100 million shares outstanding. What's the intrinsic value of its common stock on a per share basis, right? So here, the process is we'll actually find the value of the whole company using its free cash flows. So free cash flows are cash flows that accrue to the firm after all operating expenses, taxes, and investing expenditures have been met. And these cash flows belong to the firm's investors, or stockholders and bondholders. So the present value of the firm's future stream of free cash flows is the firm's total value. So company's total value is the total value of all of its, total value, if you look at the asset side, it's the value of all assets. And you look at the liabilities and equity side of the balance sheet, then it's debt plus equity, right? And so if we, and using that side, debt plus equity side, we can actually deduce the value of equity or stock. So company's free cash flows most recently is 300 million. If we multiply it with the 1 plus the growth rate in cash flow, we get 1.05 times 300 million. That becomes the next year's free cash flows, right? Next year's free cash flows divided by the company's weighted average cost of capital. And we have a whole chapter on that later, but that's the appropriate rate to use. So minus G. So it's basically, it's kind of like the constant growth model for stock, which was D1 over R minus G. Here we have FCF1 over an R minus a G. Only the R has a different name here. It's weighted average cost of capital. Anyways, so when we crunch it out, we get 6.3 billion or $6,300 million is the value of this company. Now, the question also told us that the company has outstanding debt worth 2.3 billion, right? So if we subtract that debt, we get a total value for firm stock of 4 billion. We were told there's no preferred stock, so it's just common stock. And firm stock is worth then 4 billion, which is 6.3 billion value of the firm or the company minus the 2.3 billion, which is the value of outstanding debt. Then the stock is worth 4 billion, and there's 100 million shares outstanding. So if we take 4 billion or 4,000 million and divide it by 100 million number of shares outstanding, we get $40, and that is the value per share. So that was another way of company coming up with the price per share for this company, right? And that's going to be the end of our slides, and be back with more later.